So what does this deal hammered out by Congress mean to you? We're joined by CPA Bob Martin and Lance Roberts, financial expert and advisor from StreetTalkLive.com. Gentlemen, thanks for joining us. Fascinating to have watched this, just all this Cliff talk, but we want to know what it actually means to those folks watching at home. And I want to present something to you. And Bob, your life is taxes and all of this stuff, okay? The Tax Policy Center in Washington says that the deal includes $1 in tax cuts for every $41 in taxes collected. What do you guys think this actually means for the economy?
Well, it means that the economy is going to be very slow for quite a while. This hasn't solved the big problems that we have.
Mm-hmm. Well, it would seem that way.
Well, he's absolutely right. First of all, just the payroll tax cut alone, which will expire this coming year, that's a 2% hit to, it's a 1% hit to GDP growth this year. That doesn't include higher taxes on small businesses. It doesn't include higher taxes on your biggest component of your taxpayers, which is going to reduce global domestic growth as well. But now, once we start actually talking about spending cuts in the next couple of months, that's an additional drag on the economy.
And that hasn't been solved yet. That was
right.
Sort of just temporarily for 2 months. Let's talk about this issue of the payroll tax, because a lot of people get confused about their tax bracket and the tax rates. Everybody who earns an income pays this payroll tax. How much is it now, and how much is it going to increase?
Well, for the prior 2 years, we had a break where your payroll tax was 2% less. And so if you made $50,000 a year, you got an extra $1,000. What's happening starting in 2013, you're not going to get that 2% benefit. So that's going away.
Yeah, and here's the big point about that, too, is that, when you give people extra money in this economy, wages have fallen for the average American over the last 10 years. Wages are weaker growth today. Mm-hmm. Well, when you gave them the tax break over the last couple of years, they've been spending that extra $1,000. Living paycheck to paycheck. Mm-hmm. That is the norm in America. So now once you take away, on average, it's going to be about a $1,300 hit annually to America. You're going to take that out of consumption, which is going to be a hit to GDP.
Okay, then I have a couple of questions for you, gentlemen. Why is the stock market going nuts? I don't know if you guys have seen this, but I mean, the Dow, the S&P, the NASDAQ, everybody is just like peaches and lollipops out there. I mean, it's going through the roof. Why are investors so happy about this?
Well, spending cuts are called austerity.
There's the latest. It's up 258 points.
Exactly.
2%.
Well, when you were talking about spending cuts earlier, and before the deal was done, we were talking about cutting spending, deep cuts in spending, the sequester, right, all the defense cuts, etc. That was going to be about a 1.5% hit to GDP. That's now off the table. In fact, as you just said a minute ago, there's basically no spending cuts. It's tax hikes that will come next year, mm-hmm. and pretty much spending cuts, no spending cuts currently. And you got $85 billion a month from the Fed being pumped into the system. Wall Street loves this.
So that means we should love it too. I mean, our 401ks are going to go up, right?
Yes. Financially, look, the markets are going to do well for the next couple of months until we actually start wrangling with the actual debt ceiling debate. That's going to be the next hurdle. But for the next month, it's likely that stock prices are going to rise because the Fed is kicking off in another $45 billion a month, buying treasuries, as well as $40 billion a month in mortgages. That's a lot of liquidity going to the system with real no headwind at this point.
Okay. Bob, as a CPA, if you have a client who, let's say, is a small businessman, I don't know, maybe he owns a business in Houston that fixes air conditioners or maybe heaters, this time of the year, okay? $450,000, tell us what changes, I guess, were put into this new law that are going to affect small business people like that.
Well, people actually making over $200,000 a year are going to be paying more taxes. Family units over $250,000. You hear a lot about $400,000 and $450,000, but a lot of the changes start at $200,000. But what happens is that sounds like a lot of money to the average wage earner. Mm-hmm. But if you're a small business, you don't take that bottom line. Say you made $200,000, you don't just go spend it on vacations and have fun with it. You invest it back in your business. Mm-hmm. And what's going to happen is you're going to have less to put back in your business, to buy capital equipment, to hire more employees. And so it's going to have a downward drag on the economy.
It's confusing for the little guy like me who sees what you're saying, Lance, and saying, well, there's so much money being thrown into the market from the government, from everywhere else that, okay, so I put my money in stocks because they're going to keep going up. But on the other hand, businesses are going to have less money to spend. People, all of us, are going to have less money to spend because of the payroll tax increasing. Our paychecks will be smaller, so that's less money. What are we supposed to do?
Look, this is, you know, don't take me wrong about what I said a minute ago about the market's going to like this for about a month, because that's true. Right now, there is no headwind. But coming through the rest of this year, you're going to have a continued drag on the economy. Again, rising taxes drag on economic growth because, just as you said, it takes dollars out of the system from consumption to pay taxes. But in Bob's point, very, very true. The one thing we're watching for here over the next month or so are going to be the next reports from the National Federation of Independent Business on small business consumption and attitudes. It plummeted in the last report post the election, 35 points, one of the biggest drops on record. That is likely to deteriorate further now that they're going to be, these small business owners are going to be paying a lot more in tax. That's going to reduce their ability to reinvest in their business.
Yeah, and even in the individuals, I mean, how many people can keep buying iPads and iPhone 5s and stuff when your paycheck's getting smaller and smaller?
Oh, that's right.
We have Lance and Bob. They'll be sticking around for the remainder of the hour with
$16 trillion and counting.
Months.
This is a live look at the debt clock as those numbers continue to go up as we speak. So what can you do with your money? That's where Lance Roberts comes in. As we said earlier, he's the host of StreetsTalkLive.com. Thanks for sticking around to talk to us about this.
Absolutely.
I know your phone must be ringing off the hook and your email must be blowing up of all of your investors saying, what do I do? Where do I go with this? So what is your suggestion for people who just don't know how to invest right now?
Well, look, the thing is this, is that, you know, the general consensus has been just throw your money into the market and kind of hope and pray it goes up. And unfortunately, markets don't work that way. And what we've had over the last couple of years is a tremendous amount of stimulus being put into the system by the Federal Reserve. A lot of that goes into that big number you just saw there, the 16 trillion and counting, and that's going to continue to go up. The issues coming up this year is we are walking into a lot of unknowns. Higher taxes are bad for the economy. They will slow economic growth. Just the payroll tax cut alone that Bob was talking about earlier, that's about a 1% hit to GDP. Now we add in higher taxes for small businesses, Medicare health taxes, all these other things. We're talking roughly about a 1.5% to GDP. We're growing at 1.5%. So you're talking about zero growth in the economy. That's not great for the market. So a little more in cash, a little bit more in fixed income, because bonds will hold up well in an environment of uncertainty, right? Kind of a safe haven play. And then on the equity side, depending on your age, you know, as you get closer to retirement, you want to have more in fixed income and cash, protect your principal. But, you know, select things like dividend yielding stocks or big domestic companies. They'll perform better than potentially a lot of the international companies that are struggling with the Eurozone recession.
It's so easy at a time like this to just go and pull all your money out of the stock market because you panic, but then we know that that can hurt the economy as well. So when you are saying make sure you have more in cash, are you saying that it's time to sell a little bit here and there? Or what is your suggestion?
No, it's just when you're talking about asset allocation, this is what we're talking about, right? Is how to allocate your assets. So you've got a bucket of dollars. How do we allocate that out there so that we can make it work for us? Well, in times of uncertainty, cash, holding a little extra just in money market accounts, right? That's a great hedge against uncertainty, because if the market goes down, what do I have? I've got something to go buy some stuff with cheap. The problem for most people is that Wall Street tells them is that you've got to be invested all the time. Well, when the market crashes, they've got nothing to go buy with. It's very likely we've had 3 years of a rally since 2009. We're moving into the 4th year. That's a very long stretch for a market. With the economy growing very slowly, it is likely we're going to see a really kind of volatile year. So having a little cash, maybe 20% of your portfolio in cash, 35 to 40% of your account in fixed income, the balance in some low volatility growth type equities, will help you weather the volatility and keep you out of trouble.
Let's talk about completely different type of investments like gold and silver. What is your thought there?
I like precious metals in times of uncertainty. And when you've got things like this where you've got the debt clock just rallying up numbers as fast as you can look at it, this brings in that fear of hyperinflation. It's misplaced for a lot of reasons. That's a conversation we can have for another day. But the fear makes gold prices go higher. So, you know, owning things like exchange traded type gold, silver, precious metals in general, that's part of your asset allocation, maybe 5% of your allocation overall.
It's important information to know, because when you take a look at that debt clock and you just see how it's ticking, you can't help but almost panic. I like to not even think about it. Let's also talk about the stock market. Obviously opened, the Dow opened 230. It looked great, but you talked a little bit about it with Mike earlier, but where do you expect it to go from here? I think you said about a month you expect it to hang in there and do pretty well?
It could do well for about a month, because for right now, I mean, and look, it's really hard to project out over 12 months. Anybody that tells you they can tell you where the year's going to end is completely lying. So, you know, we just don't know. There's too many things that occur. You know, look, we've got a recession in the Eurozone. You've got China slowing down. You've got Japan basically on the verge of recession. There's all these factors that come into the markets, not just, you know, just financial stocks. It's also politics. It's also the spending. It's also the taxes. You know, we've got this debt ceiling debate coming up here shortly. That's going to impact the market. Over the next 30 days, we don't have a lot of headwinds. You've got the Federal Reserve's coming in, $80 billion this month, buying bonds. That's going to put liquidity into the market. So, yeah, now that we've kind of cleared a hurdle, that kind of gives a little bit of breathing room for the market. So the markets could rally higher here in a month. But after that, honestly, I don't know.
Yeah,
So,
yeah, I know. There's no way to predict it.
And that's what I'm saying. Be a little bit more cautious, and a little more cash gives you an opportunity.
There's still a little concern about another recession because people are going to be fearful right now, and they're going to stop spending. So they're not going to be going to the restaurants. They're not going to be out at those malls, which is going to hurt everybody in return. I mean, it's just like this vicious cycle. We're seeing it come back.
That's very much the impact of the payroll tax cut. We were talking about this earlier in the earlier segment. That's a $1,300 cut for most people out of their discretionary spending. So, you know, for the average American, who is that 80% of the tax-paying market, they're living pretty much paycheck to paycheck anyway. So now we're going to take $1,300 away from them on average. That means less iPads. That means less iPhones. That means less restaurants eating out. And by the way, that's one of your key economic indicators is restaurants, and that's been declining. So when we have an economy growing roughly at about 1.8% last year. You're going to take 1.5% out of it with this deal. You're talking about a very, very slow rate of economic growth, which is going to put pressure on the markets.
Well, we're glad that we have experts like you to walk us through it, keep us calm. You're sort of a calming force. There's so many questions about what to expect.
Look, the thing is just always be a little bit more cautious. It never hurts to be cautious, right? You know, chasing the market is where you get in trouble. Be a little bit cautious here and just paying attention to what's going on and not panicking. Those generally work out better long term.
All right, Lee, it's great to talk to you this morning. Thanks for all your help. Happy New Year to you.
You too, absolutely.
Coming up next, the timing couldn't have been